Risk management in Forex trading. In essence, Forex trading is the buying and selling of currency pairs like the USD Euro or USD JPY based on the exchange rates between them. The Forex market is attractive because of its high liquidity, volatility, and the leverage it offers. But with these benefits come significant risks, making effective risk management essential. Good risk management helps you protect your capital, avoid heavy losses, and aim for consistent growth over time. Now, there are several kinds of risks that traders face in the Forex market. First, there's market risk. Market risk is the risk of prices moving against us due to unexpected economic or political events. Then, we have leverage risk, because Forex offers high leverage, which means you can control large positions with a smaller amount of money. This leverage can amplify profits, but it also magnifies losses if trades go south. Next is interest rate risk. This comes into play as interest rates fluctuate and affect currency values. Liquidity risk is when it becomes hard to buy or sell a position at the desired price, especially in less popular currency pairs. And finally, counterparty risk is the risk that the broker or financial institution we're trading with may not fulfill their end of the deal. To effectively manage these risks, there are 5 key principles every trader should follow. Position sizing. Only allocate a small portion of your account to any single trade. This way, even if a trade goes wrong, your losses remain limited. Stop loss orders. A stop loss order closes a trade at a certain price, capping potential losses. Take profit orders. Take profits let you lock in profits by automatically closing a trade when it reaches a target price. Diversification. Spread your trades across different currency pairs. This way, if one currency underperforms, others can balance out your portfolio. Leverage control. Use leverage sparingly. This can prevent large, unexpected losses and keep your account balanced. Risk management is crucial for long-term success in Forex. Stick to principles like position sizing, stop losses, and take profits. Leverage wisely to avoid blowing up your account. And remember to keep your emotions in check by trading with a disciplined mindset. That's all about risk management in Forex trading. Thank you for watching. Stay awesome and keep tuning in. See you in the next video.